Hey guys, welcome back to another exclusive podcast from IronFX. At IronFX, we're dedicated to bringing you the absolute best trading education to help you take your trading to the next level. In today's podcast, we'll be talking about some of the key trading jargons you need to know. The financial industry is full of unusual terms, acronyms, and words that we can often be left in a bit of a headspin. Getting used to trading can be challenging enough when being introduced to new platforms such as MT4, MT5, and so on. Coupled with alien terminology and not understanding such trading jargon or trading language can be a possible hindrance to a trader's journey and profitability. One of the most common terms you hear is bullish and bearish. Market sentiment gives you a view of the performance of the forex market or stock market, or in fact any particular market overall. When the market sentiment is bullish, this means that the price is going towards upside. When the market sentiment is bearish, this means the price is going down. An easy way to distinguish the difference between the bulls and the bears is that bulls have horns and toss things in the air when provoked, indicating that prices could be tossed up. When bears are provoked, they get on their hind legs and tear things down, indicating prices are decreasing, going towards the downside. Another trading jargon often thrown about is the PIP. The acronym PIP stands for percentage in point. The PIP is the smallest movement reflected in an exchange rate on a currency pair. The PIP is the fourth decimal place on a price quote for a currency pair. It is used to measure value. For example, if you're trading the Aussie against the US dollar, the quote price would be, let's say, 0.6726. This means that one Aussie dollar will enable you to buy about 0.6726 US dollars. If the PIP value increases by 0.0001 to 0.6727, this would mean that you can acquire slightly more US dollars for every one Australian dollar. Finally, when you start getting into trades, entering trades, you would be going long or short. When used in trading, long refers to a position that makes a profit if the asset market price increases, usually used in context as going long or taking a long position. When you trade in the forex market, since you buy or sell in currency pairs, going long means that you're buying the base currency and selling the quote currency. For example, if you go long euro dollar, you're buying euros and selling the US dollar. Going long is the opposite of going short or shorting, which means taking a position that makes a profit if an asset or the price falls. Another term that you'll come across, but might not usually like to hear it, is slippage. Slippage refers to the difference between the expected price of a trade and the price at which the trade is executed. Slippage can occur at any time, but is most prevalent during periods of high volatility when markets orders are used. It can also occur when a large order is executed, but there isn't enough volume at a chosen price to maintain the current bid-ask spread. Slippage occurs at all market venues, including equities, bonds, currencies, and futures. And lastly, probably one of the most important trading jargon you've read over is spread. Spread is the difference between the bid, or the selling price, and the ask, the buying price, of a currency pair. The spread is measured in pips, which, as we had discussed earlier, is the smallest movement of price of a currency pair. When there is a wider spread, it means that there is a greater difference between the two prices, so there is usually low liquidity and high volatility. A lower spread, on the other hand, indicates lower volatility but higher liquidity. So there are going to be smaller spread costs when incurred when trading a currency pair with a tighter spread. When trading, the spread can either be variable or fixed. The spread for forex pairs is variable. So when the bid and ask price of a currency pair changes, the spread changes too. Anyway, guys, that's it for me for today's podcast on some of the key trading jargons you need to know. Do remember to subscribe to our podcast here at IronFX. We're dedicated to bringing you the very best trading education to take your trading to the next level. Till then, stay safe and trade safe.